Good evening. Again, hi, I'm John Mason, Mason and Associates. Thank you all for being with us today for our webinar, Mason and Associates and SEM Wealth Management. If everybody on my team, including Jeff, if everybody would go ahead and activate your webcam so we can do a little bit of introductions for today. So again, I'm John. You guys have a full team with you today, and we know as we look at the attendee list that there are several of you that have been clients for a very long time. And then there's other clients who are maybe a little bit newer. So as we move through the presentation this evening, our goal is to speak to all of you. And the reason being is some of you have performance that dates back a long time. Others, you maybe have performance that dates back only a few weeks and anything in between. So we want to kind of start at ground zero. Some of you have never had the privilege of meeting Jeff Hyback in SEM. Others have seen him in person when we were allowed to do more of those type of events. So we're kind of going to start at ground zero a little bit with introductions. For those of you that have been clients for longer, please bear with us as we go through some of this. But number one, wanted to introduce a founding partner, my uncle, Kenneth Mason. Ken, if you could say hi to everybody.
Sorry about that, John. A little slow on the mic. Hello, everybody.
So very excited, as always, to have Ken with us. As you know, he's been in the financial planning industry since 1991 or 92. And Mike, my dad, actually hired Ken in the business at AXA Equitable back in the day. They together made a move over to Centaurus in early 2002. And then, as many of you are aware, the breakaway from Centaurus and the start of our fee-only registered investment advisory firm in 2020. So Ken's been there every step of the way. And one of his claims to fame, I guess you could say, is that it was actually his idea to begin specializing with federal employees back in the early 90s. So all of you that are federal that love our specialty with federal employees, you can thank Ken Mason for that. The fun story there is he picked up his briefcase one day, said, "I'm going to NASA. We're specializing with federal employees." And Mike said, "Well, you're not going alone." So that's kind of how all this started about 30 years ago. So thank you, Ken, for being here. Next, I'd like to introduce Tommy Blackburn.
Hey, everyone.
So Tommy Blackburn, fun story. Tommy and I graduated together, Virginia Tech, 2010. Both certified financial planners. We met in our CFP classroom together. And the fun story is senior year final project was we designed a financial planning firm together. We actually got the best grade in the class. I don't know if that's officially known to everybody, but it is known to us. And a decade later, or getting scary long, actually, more than a decade later, we're actually running a financial planning firm together in the real world. So Tommy's also an equity owner of the firm. He's a certified public accountant and CPA. And as he joined the firm, all of you have benefited from that, even though maybe you've never met Tommy before. With that CPA and tax background and the things they were doing at the prior firm, we've seen our tax expertise and tax planning skyrocket since he joined us back in 2019. And we couldn't be happier to have Tommy. So Tommy, thanks again for being here.
Thank you for that great introduction, John.
Next up, Ben Rakes.
Hi, everyone. Nice to meet you.
So Ben, a little bit similar story with Tommy. So they actually worked together at their previous firm and ended up becoming really good friends, saw each other's work ethic. So I recruited Tommy for 10 years. Tommy's recruiting of Ben was slightly less than that. Once Tommy had separated the prior firm, it didn't take long for Ben to really get excited about the things that we're doing here at Mason and Associates. Graduate of Virginia Tech, certified financial planner. Many of you on this call maybe have met Ben during your last strategic planning meeting, and he really rounded this out for us because we hope Mike and Ken are going to be here forever, but we know that that's also not possible. So Ben really kind of rounded out our succession plan. Many of you probably met him, and we'll continue to see more of him in your strategic planning meetings. And we just are so thankful to all of you clients who met Ben, embraced Ben like one of the family. I know the communication with him all year has been wonderful. And Ben, maybe you want to say a word or two about how awesome that's been.
It has been open arms welcome. And that is, I think, because one, the clients that we have are so great and so understanding of the situation, and because of the relationships that both Mike and Ken have developed with everyone. It's truly been a pleasure to get to meet everyone that I have. And as you said, John, looking forward to meeting more and more people and seeing more new faces.
And thank you, Ben, for that. And also, Ben is an IRS enrolled agent, which is a good thing, by the way. Most of the time when you hear IRS in front of anything, people get scared, but enrolled agent is a nice designation to have, and sounding like a broken record, really rounding out the tax practice, right? So we've got the CFPs, we have CPAs, we have retirement income certified professionals, and now we have an IRS enrolled agent. So really rounding out our professional services and the team that we have here at Mason. In addition, the people that are not on the webinar right now, who are also very valuable to us, Lynette O'Berry, who's been a support team member for quite some time, helping with applications, helping with transfers, rollovers, conversions, you name it. She's been a team player now for over 5 years. Kelsey, our newest hire, she's our document management specialist and largely responsible for our conversion from paper to electronic. She's been a rock star for the last few months. My mom, Bobby Mason, Chief Operating Officer, she's the glue. She holds the fort down for us, holds down the fort. Yeah, so she's great. We couldn't do it without her, and she's not here. So I just want to say a big thank you, and thank you to all the clients, because our support team does a lot for us so that we can do the financial planning side, and then our team can help you on those other tasks. So we really appreciate how well you've been working with them. Mike can't be here. He's very sad. And I say that a little facetiously because he's hanging out with Carter, my 3-year-old son, and picked him up from school this afternoon. So they're having some Carter Poppy time, but he tells all of his clients hello. He's very thankful that all of you are here. And many of the same stories apply as Mike and Ken started this firm together. Last but not least, would like to introduce Jeff Hyback from SEM Wealth Management. And at Mason & Associates, we believe that we do what we do best, which is financial planning, tax planning, estate planning, what you experience during your strategic planning meetings and throughout the year. That being said, you just met our internal team at Mason & Associates. We want you to know that you also have a team. Although we outsource some of the investment management aspect of what we do, Jeff is an extension of the Mason & Associates team. So he maybe doesn't wear a Mason hat too often or come to the Mason office too often, but we're in weekly contact with him. We're friends, we're business partners, and he's an extension of our office. So we want to welcome Jeff Hyback of SEM. He's a chartered financial analyst, the chief investment officer. SEM stands for scientifically engineered models. And what that means is we make decisions in your investment accounts and we trade those investment accounts based on data.
So what we're here to talk about today is, surviving a bear market. Obviously, it has been a difficult year. It's something that we haven't really had to deal with before. And I think it's interesting on this is that how people define a bear market. And I put this chart up here because the last time, the market puts a definition of what a bear market is, and they always say, well, it's 20%. Well, that means that every time the market goes up another 20, they consider out of the bear market. And I thought this search for the term bear market was very interesting because June 12th, 2022 was when the S&P 500 dropped by 20%. All the news media and internet sites started talking about how we're in a bear market, and everybody started searching, well, what is a bear market? You could see back in 2020 was the last time we had seen that kind of a drop, and that's what happens. I think that's a lot misleading because as I've always explained to people, a bear market is a prolonged period of price declines. I told a lot of people that we shouldn't look at 2020 as being a bear market because it wasn't down for that long. Another way to look at that is how the markets have performed at different times. And I think this chart is interesting. I picked some Vanguard target retirement funds along with S&P 500 in there. These are similar to the life cycle funds at TSP and all the different things you might see in an employer retirement plan. But what's different this time, and this is what's made it very difficult, is I put in blue the income side of the retirement plans. And you could see they barely lost compared to what the rest of the market did. Now, granted, during the financial crisis, they lost about 18%. But this time around, income investments are down almost the same as S&P 500. So that's made it very, very difficult to find anywhere to make money. A lot of times your bonds would save you and you would have a place to hide, and that 60-40 portfolio would work, but that's simply not the case this time. If you look at some statistics, and I thought this was interesting. So we have different bear markets on this table here. And you look at 2000, 2002, 51% loss, took 2.5 years of losing money, or 2.1 years, another 49 months to recover. So you were in a bear market for 74 months from the time it peaked till you made back all of your money if you were a stock investor. The financial crisis lost 55%. I found this interesting. It was only going down for 1 1/3 years. If you lived through that, it felt a lot longer than that. And that's something that does happen during a bear market. It took another 37 months to recover. So you are underwater for 53 months. And this is why I don't call the 2020 a bear market. Your total time underwater, if you were an S&P 500 investor, was only 7 months. And that's not a lot of time in the whole scheme of investing. This time around, when, through the end of September, we were down 24%. I think we're now down maybe 20-ish% now, with a little bit of rally that we had in October, going on 9+ months. We don't know how long it's going to be. And I think that's important. Another way to look at it, all bear markets are different. What causes them, on the surface at least, is different. And this chart from Ned Davis plots how long they lost, how much they lost. And you can see there's a wide variety of them. But I think it's really important to understand. Now, I'm talking about median, and that's just a statistical difference between mean or average and median. And median helps throw out some of the outliers, for instance, the 1929 crash, to give us a better idea. What should we expect during a bear market? If you look at all bear markets, typically they lose 27% and they last almost a year. If it's during a secular bull, so like we saw during COVID when the market had been going up, the average bear market is only down 20 for about 8 months. During a recession, though, this is what's key. 42% drop, and it lasts about 19.2 months. And without a recession, it's only a 25% drop in 8.5 months. So really the question becomes, is this a recessionary bear market or not a recessionary bear market? Is it just a correction inside of a bull market, or is it what we would call a secular bear market, which means it's going to last a lot longer? And to that, we turn to data. John mentioned scientifically engineered models. Here we go. This is our economic model here at SEM, all quantitatively based. And I just helped you out there with some arrows there. There's only one area that's doing well, and that's related to the job market. We're going to find out tomorrow, actually, how the job market's doing. And I think it's doing okay for now. And that's one reason people haven't said we're in a recession yet. But I'm going to show you here in a minute why I believe we are definitely heading towards a recession, because these jobs that we hear, you can see the pace of jobs in hours has flattened out. We're likely to see that go lower here fairly quickly here in the coming months. One thing I want to remind people of, we had a huge drop, but if you go from the end of 2019 till where we're at today, the economy is only up 3%. Now, that's not an annualized 3%. That is 3% total. So from 2019, our economy is slugging along. There is something going on with our economy. More importantly, it's not just COVID. If you go back to 2016, you're looking at only 2% growth annually for GDP. Now, you could see we had a few years where we exceeded that. What's important to understand, though, is we never got above 3%, which is the long-term average. So even with the tax cuts, all the stimulus from the Federal Reserve that they had kept in place, we still failed to grow at above average rates. And we've only been growing at a 2% rate. When you compound that and look at what's happened, now this is to scale. So we have a $20 trillion economy. You could see we put half of our economy into what we would call stimulus mode via the Federal Reserve quantitative easing, the 2020 stimulus bills, and then the 21 stimulus bills. So half of our economy was dumped into it. And the problem, as I said during, I think the last time we did one of these webinars was back in 2 years ago in November 2020. The problem is we gave a lot of money to people who really didn't need the money. They were able to keep working. They were already retired. And so they ended up spending the money. And that shows up in the consumer spending data. As I put some triangles on there just to have a more big picture view of this. And I drew a trend line from the Trump tax cuts to say, well, this is the pace we were on. You could see the drop when COVID hit, and then we had the stimulus checks. Well, when we got back to break even, we were back on trend. We were sending the stimulus checks still to people. And the biggest issue, I believe, is the Federal Reserve kept stimulating for another 11 months before they finally decided to try to slow things down. The bigger issue, though, is if you look at real disposable personal income. So what this basically is how much money do you have when you account for inflation and after you've paid taxes? And we're now back to the point of the same level of income as we had before COVID. And so that's going to start wearing on people. That's going to start being a real issue. And I didn't have time to add it today to this presentation, but I just saw a chart on credit card debt. And credit card debt was declining all the way until April 2021. And then as that last stimulus check hit, the usage of credit card debt has gone up and up and up to the point that we're back to $1 trillion of credit card debt. The savings rate is the lowest we've seen since before the financial crisis, going all the way back to 2007. So people are spending down their savings, and that's a real issue for our economy going forward. Now, here's a chart that I've shown in pretty much every presentation I've done over the last 10 years. And it's the short-term view of the S&P 500 going all the way back to the bottom in March 2009. And one thing I always reminded people of, buying the dips works until it doesn't. And so often we've been conditioned over the last 12 years that, hey, if I had bought that dip, I made a lot of money on that investment. So people were conditioned to buy the dip. The problem is, and this is the problem that we always go through, is the market moves in cycles. And this goes back to 1990. And here's what's important is the average return for stocks annually going back to 1990 is right around 8%. When you add dividends, you would come up with 9 to 10% annualized returns for investors. But we've had periods of time. We just finished the third period of time where stocks went up in the mid-teens every year, which is way above average. And the only way you get to a long-term average is you have periods of time above it, and then you spend time below that. And that's where we're going through now, as I put on the chart. Excesses are being removed. We're to the point now where we got to pull things back because it got too fast, too quickly, and now we're giving that back. And if you want to zoom in a little bit more and kind of look at what's happened with the market this year, we can pinpoint the exact problem for the market is we've been used to the Federal Reserve stimulating things for so long and saving the day that when the Fed warned on January 3rd about the need for higher interest rates to fight inflation, it's pretty much been, that marks the day of the beginning of the bear market. Now, we've seen rallies, and this is important to understand, is we probably just finished another rally. I'm hopeful that maybe we can get a Christmas time rally again. But the market rallied 10%, hoping that the Federal Reserve was going to say they're getting close to being done raising interest rates. We learned yesterday that Jerome Powell said, no way, not only are we not done raising interest rates, we're probably going to raise them longer and higher than people thought. And in fact, this is the interesting part, higher than the Federal Reserve told us 6 weeks ago. So we keep trusting what the Federal Reserve says. But if you go back to the beginning of January, when they said they had to fight inflation, they believed that they would have to raise interest rates to around 3%. Now, after the meeting yesterday, they're saying they're probably going to have to be around 5.5% before they feel like they're done. Now, of course, I wouldn't jump to any conclusions and say, well, that's what's going to happen, because we should learn by now that the Federal Reserve is very often wrong about their forecasts. Now, here's the important part to understand. This is the chart of the market going back to 2009. And I added in there, and we don't need to understand every little piece of text in there, but every time during the last bull market, when the market had a hiccup, and usually it was down about 10 to 12%, the Federal Reserve would jump in and they would start stimulating, or they would pull back some of their policies that they thought were too tight. That's what people got used to. That's why buying the dip was working. What people fail to realize is the Federal Reserve has always tried to do this. You go back to the 2002 bear market when the tech bubble burst, the Fed cut rates by a total of 6%. And we saw rallies of 12, 7, 19, 22, and 21% before this bear market was over. Before the stock market was down 50%, we saw some big rallies. It was even more magnified if you go back to the financial crisis. The Fed cut rates from 5.25% down to 0. They couldn't cut rates anymore. They did quantitative easing, what we called QE infinity, to try to jump the market. And we saw some nice rallies for the stock market, especially this one, 24% near the end of 2008, only to see the market end up going to even new lows. So that's something to keep in mind inside of a bear market. And for now, the data says we're in a bear market. We're going to see big rallies, but that does not mean that it's over. The other thing I wanted to just touch on before we talk about some of the strategies that we've put in place for this bear market is we need to understand that the market is a series of overreactions in both directions. And what I mean by that, I called the 2021 rally stupid. There was no better term for that, because we saw things like GameStop and Bed Bath & Beyond and AMC and Avis Rental Car and all these different, ARK investor funds just making 100, 200, 300% returns. That made no fundamental sense. There was no financial backing behind those moves. People were overly optimistic. They believed everything was going to be great. And now they're probably going to overreact in a different direction. And this is a chart that plots what we as individuals will go through, our investing cycle, as we call it. Your life cycle of investing goes through, most people got pretty euphoric in 2021. Everybody goes through this cycle differently, but the market overall also ends up tracking these cycles. The market's kind of a voting mechanism. If I were to guess right now, we're somewhere in the fear and denial stage still. We haven't reached a point where I'm seeing panic. The numbers don't show that people are despondent. They're just not there yet. And the scariest part of the bear market is when everybody starts to move in that direction. And our job is to help you guys avoid falling for these emotional pitfalls that every one of us are inevitably going to start to feel at some point. So 3 steps to prepare for a bear market. Now, for your reference, because we've done this across the country for a lot of different groups, we actually wrote this back in 2018. So these steps are designed for every market, because no matter how this plays out, you're going to go through another bear market. And this is something that we've found in our 30-year history that has helped people prepare for a bear market. And we're going to touch on these because your advisory team at Mason & Associates, along with SCM, have really done a lot of these steps already for you. And we just want to remind you of some of those steps. So number 1 is just understanding your true risk pulse. Now, this is different for every person. And, all of the advisors at Mason & Associates do a really good job of understanding it, because it's a lot more about how things are going. But here's the thing to understand right now. If you're uncomfortable right now, reach out to your advisor. Let them know that, hey, I'm feeling a little bit uncomfortable. That's the first step you want to do. And this is the other thing, and I haven't seen a lot of Mason clients that have done this, but maybe in your retirement plan outside of your SEM accounts or somewhere else. Did you add to the stock market in 2021? And if so, you might be feeling a lot more uncomfortable because you didn't get some of the upside benefits of that. That's a conversation you should have with your Mason advisor. And we always say use an objective risk questionnaire that focuses more on your personality. A lot of you have already taken it at risk.semwealth.com. When you do that, when you put your advisor's name in there, that automatically generates a portfolio review by me, where I'm going to look at it and then I'm going to get in touch with your advisor to say either they're in the correct portfolio, or maybe here's some adjustments that we might not want to schedule a meeting for with you, the client. So that's really important. But most importantly, and this is where it circles back to working with your advisor, is what does the financial plan say? I'm pretty sure that everybody out there was put into the current investment portfolio because the financial plan said this is what works really well for you. So that's important to understand. The other thing that we like to point out is how important it is to minimize losses. Kelsey did a really nice job for us ahead of time. Everybody who signed up for this, she told us what portfolio bracket you were in. And what's interesting is at SEM, we've always found over 30 years that the average client tends to get uncomfortable around the 20 to 25% drop in their portfolio. So the average client tends to be in that point. Well, everybody on this call, the average risk tolerance is right around 22, 23%. So we're right in this point, because if you look at this line, so the yellow is the loss and the blue is how much you have to make to get back to break even. And the easiest way to understand that is if you have $100,000 and you lose 50%, you're now at $50,000. To get back to $100,000, you have to double your money or make $50,000 on that $50,000. So you need 100% return. Well, if you look at these lines, it starts to go what we would call exponential, right around the 30% risk level. So what this tells us is if you do lose 25%, we can easily make that back up in a normal market cycle, because we're not going to have to take excess risk with your account. And that becomes especially important inside of a bear market. The other thing we want to remind people about is emotionally, we experience losses at twice the level that we experience gains. So all the good returns that we've been able to get over the last 12 or 13 years, that has not felt as good compared to the pain that we're feeling on the losing side. So just keep in mind, when you lose money, it does hurt more. Now, number two, and we're quickly going to go through the rest of these because, again, the Masons advisors have already done a lot of these. Review the impact of a bear market. They look at the income from your portfolio, how much is needed, making sure that we have the income needs taken care of in lower risk investments. Which type of account are you taking it from? There's a lot of tax planning in there. And then in the financial planning software, they can run worst case scenarios. So again, going back to number one, your risk pulse is based on your financial plan. So if you look at bear markets again, here's this slide again. And again, all assets are going to lose money in some degree during a bear market. But the key is we want to take income out of the lower risk assets so that you're able to get the benefits of long-term investing. So step number three is developing a plan for any portfolio adjustments. Number one, this is where the risk questionnaire comes in. If you're at all uncomfortable, take it. I'm going to look at your account and get with your advisor, and we'll have some recommendations and a conversation with you. So we will look at, do your portfolios match your true risk tolerance? What I'm talking about here is if you have money outside of Mason and Associates, whether it's your TSP or your other retirement plan or just a brokerage account, look at adjustments you can make over there with those accounts as well. Are your expectations properly established? I'll tell you right now, we're probably 2/3 of the way through this bear market, which means we do have some more downside. We need to expect that. We need to plan for that. Are there components designed to help you stick to your plan? And I'm going to talk about how at SEM we've set your portfolios up to do just that. And do you have to be right? This is the one thing, if you buy the dip today, you have to be right. But the way we do it at SCM, we don't have to be right. We can adjust as needed to what's happening out there. And then most importantly, how and when are you going to make adjustments, to your portfolio? You have to have a plan. Here at SCM, we definitely have a plan. I want to show this chart, and a lot of you have probably seen this. We call it our bubble chart here at SCM. We talk about different investment buckets that your money is invested in. And these are the components of the Mason models that we use. And this is what I'm talking about, where we want to have strategies that are different based on what the needs are for the account. So your short-term buckets, tactical bond, dynamic income, and core bond are all parts of most, if not all, Mason portfolios. They're literally sitting in cash or other low-risk bonds right now. Yes, we took some lumps at the beginning of the year because we were in a bull market up until then. And it took some time for our data to adjust and say, okay, things are getting worse. But where we're sitting at currently, the low risk money, including in the bond market, is in low risk bonds or even cash, treasury bills, things like that. All the way out there to the right, though, on the growth side, we've taken some money off the table, but it's still designed to be a long-term investment. And then we always want to have long-term money because most of you are long-term investors. So if you're in, a balanced portfolio, you're going to need long-term money. And because we took money off the table on the short-term side, that allows us a long-term side to take advantage of the benefits. Because here's something important to understand. Over 10 and 15-year periods, yes, the S&P 500 has been negative over those periods of time. Not very often, but it has happened. Going all the way back to 1926, and I will say past performance is not a guarantee of future results. However, we have almost 100 years worth of data now. There has not been one single losing 20-year period for the S&P 500. So if you don't need the money for 20 years, the stock market is still the best place for your investment. It's going to provide the best long-term value. Everything else we've adjusted according to your financial plan and your income needs. We didn't talk about inflation today. I know it'll probably come up in the Q&A. Beginning of the year, we were talking about how we could be in different inflation environments. Right now, I think it's pretty clear. The economy is declining. We're dealing with inflation. So what's our plan? Stocks are going to struggle in that environment. AmeriGuard, we have trend indicators. We've already reduced the allocation. We've gotten completely rid of small caps, which tend to struggle in this environment. And we can invest in materials type sectors. We have a position in the Dow in AmeriGuard, which is heavy in materials, heavy in energy, things like that. Treasury bonds are going to struggle. Obviously, we've seen that already. But there is a component inside of pretty much every Mason model called dynamic income. It's not only in shorter term bonds, it's actually making money as interest rates go up. And it's been a really nice place to buffer some of the losses we've had elsewhere in the portfolios. And then high yields and corporate bonds are going to be slightly better than treasuries, but we're still going to spend a lot of time in cash. Now, that's where we think we're going. We might shift back to not having to deal with inflation, and our models are designed to do that. One thing I want to talk about is we're not perfect, but we're going to have models designed to, as John said, not adjust based on how we feel, but actually what the data has been saying. And this goes back all the way to last fall. Our economic model went from bullish to neutral just before the fourth quarter started, and then the market went up like crazy. And so everybody was saying, well, why did the economic model get neutral? And now we're starting to see, yeah, it was ahead of the game, but it took action accordingly. It actually got bearish in April, and you see that in orange there. That reduced our exposure, that put us in positions in the bond market that helped us buffer some of the losses we were seeing elsewhere. AmeriGuard has taken money off the table. It took money off the table in February and March. It did just add back in a little bit here, but that could go back into cash or short-term bonds as early as Monday, it looks like, when you look at that model. And then in between, our high-yield bond models have had some buys and sells in between. We don't know when this will end, but we do know it will end. And that's important to understand. There will be a time where the data says it's time to get back into the market, and our models are designed to step back in And if they're wrong, to get right back out where they were. So I want to close with this. This is what we call the behavioral portfolio approach pyramid. And we constructed this, and it works perfectly with what Mason and Associates does for you. Is every decision is based on your financial plan. That's the base of the pyramid. And right above that is your cash flow strategy. How much income do you need? Do you need any income at all because you have pensions? All of that works up to the different types of investment accounts you have, whether it's an IRA, a Roth, a trust, a taxable account, something else. SCM steps in with step 4, but everything we do is designed to work with steps 1, 2, and 3. And that becomes important. As John said, we meet weekly. We're a phone call away. Just before this meeting, I was talking to Ben about a client and their situation. That's the relationship we have, is how does your investments with SCM interact with your financial plan, cash flow strategy, and the different types of investments you have. So finally, John wanted me to mention this because it's a resource that I'm not sure that a lot of you who are new are aware of. If you go to scmwealth.com, first of all, you can get to the risk questionnaire under the More button. You could see it right there. But what's most important is at the bottom of the window when you log in, it says SCM Market Insights. There's a button that says SCM Traders Blog. Inside the Traders Blog, you're going to see, when you click on that, the SCM Market Update. And it's going to have these, whatever you want to call it, we call them speedometers, to show where the different models are sitting. We have tactical, which is daily managed, dynamic monthly, and strategic is more longer term. Right now, they're all sitting in bearish mode. There's going to be a point where they're going to shift. Every Monday morning, look for, we call it the triple M, Monday Morning Musings. That's just me taking a look at what all the data says and telling you what's important with that. If you are on social media, you could give us a follow as well, because we talk a lot about in real time what's happening there. 1 minute to 3 minute videos about different things. I wanted to get to it today. I didn't get to. We're going to have a breakdown of what the Federal Reserve did yesterday. So lots of tools out there to just give you some market knowledge that's going to be different than you see in the financial media. So with that, I think I am going to stop sharing my screen and turn it back over to the guys for Q&A.
Okay. So if you haven't noticed, we've lost the power at Mason and Associates. So we're in this brand new, beautiful building, and it appears that maybe Dominion, there's a lot of construction going on. So it appears we've lost the power. So I apologize. I'm awfully dark here, but we're doing our best. So a couple of highlights that I see that happened during Jeff's presentation today. And I also want to highlight a few ways that we work together. So for those of you that have been clients all year, and for those of you who became clients more recently, we're not invested the same way we were January 1st. And you can see that. I love that SCM Traders blog. So for the few clients that have called in and have some concerns about what's going on in the market, being able to show those speedometers, like if you just wanted to see that, you don't even have to read it. How are we invested today? Speedometers are bearish. That's how your portfolio is invested. And once the data says get back in, one component may move independently of the other. We did want to acknowledge that this year has been really hard. And it's been really hard emotionally. It's been hard for a variety of reasons. And we feel it too. And although we try to remain unbiased and unemotional when it comes to money, seeing your accounts go down, seeing our assets under management go down, seeing our personal accounts go down, we want to acknowledge and let you know that we know it's hard. And like Jeff said, if you're feeling uncomfortable, that's normal. I'm feeling uncomfortable because I don't like seeing my account go down, but I still know we have a plan. I still know that my financial plan works, and we know that yours does too. So it's okay to have that human emotion. If you're feeling like you need to make a change, that risk questionnaire that SCM has is phenomenal. We don't typically use a ton of those at Mason and Associates, but we do talk about your risk, and we make sure that your portfolio is aligned with your financial plan. And we've discussed all of that, but if you want a different flavor, you want to look at it again, that risk profile questionnaire is really great, and it would spur a conversation. If you're thinking of making a change, here's what we can promise you. Our advice is never going to be, don't look at your statement and have a glass of wine. Okay. That's never going to be the advice that we give here. If you're looking to make a change, we're actually more concerned on what's happened. What's happened is, are you sick? Have you received a bad diagnosis? Is one of your children or family members ill or not doing well? Has something changed in your life that's materially impacting the way that we should be invested? Because if there isn't a material change, what's happened this year shouldn't derail the plan that your lead advisor and Mason and Associates and the financial plan that you've created. Nothing that's happened this year derails that. But if something has changed, that's when we need to know about it. And we want to help you make adjustments if they're needed, but we would just encourage you to be very careful right now, because we don't want to get into a situation where you're a balanced investor and you want to scale down to an income, and then you're looking to us to scale you back to growth or aggressive again in the future. That is certainly a recipe for disaster. So what we want and what we hope that we have with each of you is an all-weather portfolio. When the market's up, we're up some and we're happy. When the market's down, we're down some and we're happy. Or happy as we can be in a down market. Across the board, we're thrilled with our performance this year. We're keeping up or exceeding benchmarks pretty much throughout, and we couldn't be more proud of what we're doing for you guys. Even though we're seeing red numbers, and that's not fun. Zooming out, the alternative is not as typically as good as what we're seeing inside of the Mason model. So thank you for staying the course. We know it's super hard. We are going to do some questions here. But before we go, I do have a few other comments that I want to make sure that we use today as well. And we're still back to where we were in 2020. So although we did give up those 2021 gains, it's not like we're going back to what your portfolio was like in 2015 or 2012. It's still hard. Your portfolio's done well. A lot of the concerns that Jeff mentioned are economic related. And I think sometimes what happens is people look at economic news, they look at economic inflation and economic spending and all of those data points, Jeff, that you mentioned, which are awesome. That's affecting almost everybody that's not a client of Mason and Associates. And that doesn't mean that those things shouldn't be looked at, and that doesn't mean that those things aren't scary. But let's put this into perspective. A CSRS person retired is going to receive an 8.7% increase on their pension next year and received a 5.9% increase last year, a 1.6 the year before that. And when we look at our clients' true inflation rate, because your house is paid down, paid off, or on a fixed rate, your interest rate on your vehicles is low, the payments are fixed. Most of our clients, their income is growing at a faster rate than their expenses are. Your real inflation rate is not what we see in the media. It's not what we see on TV. And in fact, most of you are not even taking withdrawals, which, to put that into perspective, clients who are taking withdrawals right now are safe and okay, and we're in a good position. Clients with a lot of guaranteed income who aren't taking withdrawals are even in a better position. So nothing has happened this year that derails any financial plan. If it does, or if it happens in the future, it doesn't mean it's derailed for a lifetime. It means maybe we need to make some short-term adjustments until things get a little bit better. So keep that in perspective, keep that in mind. For those of you with large pensions, your probability of success in a retirement plan was basically always 100%. There was not going to be a point in time where you run out of your guaranteed income from the federal government. So we know that your plans are solid, but that being said, we're here for you. So a few other things to share on my end, and then we'll kick it off for some Q&A. Jeff mentioned this earlier. I think many of you know this as well. We are canceling our radio program at the end of this year. The reason being is it's worked great. We just don't feel like it's necessary anymore. So we're going to pivot 100% to our Federal Employee Financial Planning podcast. Those transcripts, those audios are posted on our blog at masonllc.net. And you also can view those on like Apple Podcasts, Google Podcasts, Spotify. And then we did just record with Jeff Hyback episode 27, which is going to be an extension of this conversation as well. So be on the lookout for that. Couple of things that we wanted to highlight on this screen here, and forgive me as things have changed just a little bit with our lack of power. So a couple of things deduction wise in Virginia this year, we have seen that Virginia is going to actually exempt $10,000 of military pension income this year. Awesome. It's going to increase to $40,000 over the next couple years. Standard deduction in Virginia rose. Roth conversions, donor advised funds, QCDs, all of these things are still applicable. So we want to make sure we're taking advantage of opportunities where we can. And there are opportunities even in a down market. And we'll talk a little bit more about that. Quick updates, cash strategy. If you haven't looked at your cash strategy in a while, it's time to do that. Langley Federal, Bayport, both of those, Chartway, have like 19-month CDs paying 4%. We've got a money market account at Axos that's paying almost 3%. We've got Series I savings bonds that were just issued with a base rate and are coming in at 6.89% rate of return for the next 6 months. So much opportunities out there. If you have idle cash, that's something that we want to talk about. And then as far as updates on legislation, there is a possibility for a new Secure Act to come out. And if that does, just know that we're going to be on the front end with any legislation that comes out there. Okay, so last but not least, and then we'll turn it over to questions, and Ben's going to moderate those, is I want to highlight one more time in detail who SEM is, why we work with them, and why this partnership is so valuable for our clients at Mason and Associates. We outsource a lot of the investments to Jeff and his team at SEM, and we've been doing that since 2011. While they're managing the money, we're managing your tax plan. While they're harvesting losses, we're helping you update your estate plan. When they're looking and saying, should we be in growth or value stocks, we're helping you fill out those retirement applications and Medicare applications and Social Security. So we rely on Jeff and their team, and we monitor them frequently. But this is a joint thing. It's a joint venture, and we couldn't be happier that we allow them to do that. We hired them as a sub-advisor to do this for us because we believe that it brings more value to you, the client, to have a dedicated planning team and a dedicated investment management team. And the fee that you pay Mason and Associates is SEM's fee is included in that as well. So we have a contract with them. We pay SEM for their services. So all of that is included. And I just wanted to again say thank you so much. And let's turn it over, Ben, to questions.
Well, thanks again, Jeff and John, for a great presentation. I'm sure many of you may have had some questions as Jeff and John were going over their piece of the presentation. What we'll start with is the questions that folks have sent into us before the webinar, but there is also a Q&A button that should be at the bottom of your window. And if you have any additional questions, please feel free to type them there now. I do believe there was one that was typed earlier, and we'll be sure to get to that. So the first question that came in before the webinar was, what alternate strategies did we use in financial downturns like we have now based on lessons learned from past downturns? Jeff, I think that sounds like a good place maybe for you to jump in there. And maybe we already answered some of those things, but what are your thoughts?
Yeah, I think that's something really important. We talked about it going into this of one of the biases we have is to look at what caused past bear markets, and then our brains will tend to focus on that. And so what we saw in 2021 was people said, I'm worried about the next financial crisis. And people argued, well, the balance sheets of corporations are fine. The banks are fine. There's not a lot of speculation. Therefore, we're okay. And they'd say, well, what about the tech bubble? Well, that was really high PE ratios. Yeah, there's a few GameStops and Avis and all that are highly valued, but overall, we're not there. So our brains were saying, okay, there is no risk out there. I see nothing coming. But what I always warn people of is it's always the unknown risk that gets our brains going. And for most people, including the Federal Reserve, they said inflation wasn't going to be a problem. And now that's just kind of turned into this painful thing. But what's key, and this is why we do what we do with SCM, is at its very basic level, stocks go up when more people buy than sell. Stocks go down when more people sell than buy, because they're always trying to find the equilibrium price. So if you have a flood of selling, the price is going to be matched down here. So we at SCM don't care what causes it. Obviously, it's a concern. Dealing with inflation is awful. We just look at the numbers. And so everything we do, whether it's tactical bond, which looks at high yield bonds and that trend, if more people start selling them than buying, we want to get out at a certain point. And we use history as a guide. We've done this for 30 years. We actually backtest, tactical bond in 1988, I believe. Our other models can go back to 1950. The dynamic models look at the economy. If the economy starts to roll over, that's bad for stocks. So we adjusted accordingly. We don't care why. And then even on AmeriGuard, where we took money off, more people were selling than buying. It hit a certain threshold where history says it could start accelerating, and we get out. So it's, in one sense, every bear market is going to be caused by a different thing, but at its basic level, it's going to be caused because more people are selling than buying. And that they sell because their expectations are not being met.
And Jeff, I think that was a wonderful answer. I'll just also add that in the time that we've known you, which is over a decade now, some of the systems that you've been using at SEM, the trend following or the forward-looking economic indicators, some of those have existed pre-2011, but you guys aren't resting on your laurels either. Like, you're actively looking to improve these things. We're going to have new data 10 years from now that we didn't have in 2022. And the advantage of working with, and the reason we hire y'all is for that, the daily looking at this stuff, the constant improvement. You could have easily stopped improving tactical bond a decade ago and would have been fine, but we're in a better position now because you guys continue to look at that. So thank you.
Yeah, thank you. And that's a great point, just to tag on to that. I don't remember if it was in one of the other questions, but there's literally never been a time in any of our careers, including Ken, Mike, and I go back 25 years, Ken longer than that, and Mike even longer, where bonds have gone down at the same time stocks have gone down. So this is new for everybody. If we were just sitting around the room, we would literally all be guessing, trying to decide what to do. We're able to take the data and say, okay, well, even though this didn't happen then, it did happen in the mid 80s. It did happen in the late 70s. It did happen in the 1960s. We're able to test it and get enough of a feel to say, okay, well, here's some adjustments we should make. Dynamic income, that position I talked about that makes money, that's never had to be used because it's never happened, in our history, but it was sitting there on the sideline ready to be put to work. And it's been a nice buffer for our portfolio. So yeah, our hard work at SCM, where most of our money goes to, is research. We have our own investment committee that meets every Friday. I call it, Jeff and the nerds, because, I'm a nerd when I meet with you guys, but, Rick's an engineer, Steve goes in a PhD in engineering, and Dustin Briles has all these computer degrees and he does programming, and they start talking about discrete mathematics. And I'm like, let me know when we talk about finance, because I'm out. So that's always happening, and we'll never rest on our laurels, because there's always new things we might discover.
Jeff, you mentioned a piece during that last answer of yours about we typically don't see the stock market and the bond market going down at the same time. And that segues into another good question we have is, why is the bond market dropping with the stock market, and what makes this different? So maybe you could hit on that more specifically.
Yeah, absolutely. So the key, if you think of a bond, when you buy a 10-year bond, and we'll stick to the 10-year bond right now, you're basically they're making a promise. They're going to pay you back a fixed interest rate. And then at some point in the future, they're going to pay you back the principal. So we'll just use $1,000. I buy a 10-year bond at $1,000. I'm not going to get my $1,000 back till 10 years from now. So if inflation is going to be higher than I projected, the value of my bond goes down, which means the interest rate that I require is going to go up. So the bond market right now has been worried about inflation. So, and I've said it before, once the bond market feels that the Federal Reserve is comfortable and they're going to actually get inflation under control, you'll see yields start to come back down on the 10-year, not the short-term bonds, but the 10-year. But so right now we're concerned about inflation. If you go back, and I took out the inflation chart just for time's sake, but the Federal Reserve has tried to get inflation to 2 to 3% for 22 years. We've not gotten there. We just barely crossed a 5-year number that's over 2%. And that's after 8 or 9% inflation the last 12 months. So there's been no inflation. So in all of our investing lifetimes, inflation hasn't been a problem. So when the stock market started to go down, people would buy bonds and that would be a buffer. Well, right now, inflation is causing the bear market, and that's bad for bonds. It's sometimes worse for bonds than it is for stocks. So it's all about inflation that hasn't really happened in our lifetimes, or I should say our investing lifetimes. Some of us are old enough to have lived through that. You know, maybe we were children, but it's still memorable to have this kind of inflation.
So we've got the Fed fighting inflation and the stock market going down at the same time. Certainly not anything that we have seen replicated too many times. Another question here would be, and Tommy, maybe this is a good question for you if you want to chime in, taking a little bit different approach, going a little bit away from stock market and the economy. But another question was, what are the advantages of Roth conversions and I bonds? And I know this is going to be specific to different clients, but maybe can speak generally about how those work and why we might use them in a plan.
Thanks, Ben. It's always going to start with it depends. It really depends on your financial plan, your tax plan, as to whether and when these make sense. For many of our clients, you're able to retire earlier than much of the private sector. So many of our clients retire in their late 50s, early 60s. And the reason that's significant when it comes to these Roth conversions is you don't have required minimum distributions starting until age 72 currently, which that creates taxable income to your plan. Your Social Security may be delayed until age 70. So you may have a really beautiful tax window when we look at planning of very low taxable income years. Let's fill these up. Let's bring forward future income that's going to be taxed higher to today. And that can add quite a bit of value. So it really depends. We also look at, we're in historically low tax brackets. So we may want to take advantage of these very, very low tax brackets compared to where we've been previously. And they're set to go up automatically in 2026 unless the laws change. There's also another saying why this year may be a good year to do it, if your plan calls for it. If the plan was at some point, we want to do a 20% conversion of our IRA. Well, based upon where the market is, we may be able to do that same dollar amount, but it's 30% of our IRA this year. So because markets are down, as long as we believe they're going to continue to go back up, which we do as our team, we can do it at a cheaper price. We can do more of it than we could at the beginning of the year. Some other advantages of Roth IRAs is it's going to lower those future RMDs we talked about. So a lot of this, talk with your advisor. They can give you a more in-depth conversation around this. We also know many of our clients, when you're at Medicare age, you're paying those IRMA, those Medicare adjustment amounts. So if your income is higher, they test it. So doing Roth conversions proactively may throw you into an IRMA potentially for a year, but it long-term may lessen the impact of those by taking control of your income while you have a chance. So by and large, Roth conversions can be a good thing, but they are very specific to your plan, because that was a long answer. And then we also had I-bonds. What are some advantages to those? If you have cash sitting around that you don't plan to invest or use for at least a year, I-bonds continue to be make a lot of sense. We can only do up to $10,000 per year per person. So a married couple could buy $20,000 in calendar year 2022. If you have a revocable trust, you can buy some more that way as well. You have to hold them for at least 1 year. You can hold them for up to 30. If you surrender them, cash them in within the first 5 years, they're going to keep 3 months of interest. They were paying 9.62% on an annual rate, which would have been 4.8 for 6 months. They are currently paying, the new rate is, I think, 6.98% on an annual, so a little over 3% for 6 months. And then it's going to reset in 6 months when they look at inflation again. So to us, it seems to be some of the highest interest rates you can get on basically cash, because this is U.S. government debt. And it's also, the interest is state tax free when you realize it. So it goes back to John's point about the cash strategy. If we have some cash that we just want to keep as cash, but we can go 1 year without using it, we think I-bonds continue to look pretty attractive.
Thank you, Tommy. And, I-bonds are wonderful. They're good for savings account money. They're not necessarily, we have from some non-qualified accounts too, like taken from a bond position inside of a non-qualified account or brokerage account that we're managing, sent it to a client or two so they could then turn around and buy I-bonds. But we typically don't get into a situation where we're taking money from an IRA or Roth IRA to then go and buy I-bonds. So it could maybe make sense to raise cash in a brokerage account, but ideally that's coming from savings. And then for those of you in a higher tax bracket, it's tax deferred until you cash it out, which I think Tommy may have mentioned too. So that's pretty neat. And then Roth conversions, all those great points. And then, adding on that when one of you dies, if you're a married couple and one of you passes away, your surviving spouse finds themselves in a single tax bracket. And all of a sudden now we're up against IRMA and Medicare adjustments and higher rates much quicker. It's hard to predict, and we don't want to predict when those things are going to happen when a spouse dies. But having some money in Roth is very helpful when that surviving spouse finds themselves in single brackets. And your kids will like it too, because if you enjoy leaving inheritance to your children, they will prefer a tax-free inheritance over taxable.
Great answers, gentlemen. Sticking with Roth IRAs, since we're on conversions, and Tommy, you hit on this just a little bit already, and I'll combine these two questions together. Is one, should I continue with Roth conversions in this down market? And then two was, when should we contribute to our 2022 Roth IRAs based on market trends? Tommy, maybe you and Jeff can both answer that question.
Sure. So, and Jeff, I'll let you run with probably the market trends one. Just as far as Roth contributions, we currently can do 6,000 if we're under age 50. We can do 7,000 if we're over age 50, and we meet the income limits, which are roughly about 200,000 a year. So again, work with your advisor to make sure you qualify for that. We have until April 17th of 2023 to do 2022. So we have time. As far as market timing, Jeff might have, or market trends, Jeff may have a little bit of insight there, or maybe he'll have the same thing that I'm thinking, which is money's going a lot further invested in the market today than it was at the beginning of the year. So we don't know what the future holds, but it seems like it's probably a good time. The only reason we might delay it that I can think of from a tax standpoint is just wanting to make sure that your income qualifies. So sometimes we like to wait until next year just to make sure we're not going over the income limits.
Yeah, and I'll just tag on to that to say, if you think you're well under that income, a monthly contribution is way better, because then you're stepping into the market every single month. And I know a lot of clients do that. And yeah, timing, I know, the whole team in Masons has been good. If it's a big conversion, not just an individual contribution, we have different mechanisms, if we step into the market every month or whatever to smooth things out. But to Tommy's point, if you love stocks at the beginning of the year, they're on a 20% sale right now. So, and if this is long-term money, 20-year money, trying to get it perfect is not going to really, matter in the whole scheme of things. from there. But again, if you can next year, look for monthly contributions, and that makes it a lot better long term for you because you're always getting in the market every month.
We hate to end every question with consult your advisor since we are your advisors, but I think in general, what we're saying is if the market's down right now, one, yes, it's a great time to do a Roth conversion, particularly if you were planning on doing one already. And those contributions, I know Jeff doesn't have a crystal ball and neither does anyone here on this panel. So now is a good time as any to make those contributions. Again, as Tommy said, making sure we're still under those AGI limits. John, pivoting here again, this is an interesting question. At what point would decreasing portfolio values cause fees to Mason? We realize there is an impact. How would it work?
Well, thank you for the question. And for those of you on the call, you're probably aware of how we are compensated. So our fee schedule is we charge 1.5% on the first million of assets, 0.75 on the second, and then 0.5 on everything above 2 million. So it's kind of like a tax bracket. You pay through those tiers. We are not increasing fees right now because the market is down. Will we increase somebody's fee in 2023? The answer is probably yes. But when we're analyzing and determining whether or not a fee increase will be presented, we're right now doing an internal calculation of current balance times 1.2. So basically taking those clients back to where they were on January 1st or even higher as we even assess, do fee increases make sense? Do we need to increase fees? So I think the answer to this question is fee increases are possible, not though because the market is down. Our business plan is solid, just like we know your individual risk profiles and know how much you're willing to risk in the stock market. We get quarterly reports from Jeff on how all of you are invested. And we're able to look at our assets under management and build a budget and make decisions based on expected volatility as well. So just like your financial plan is solid, Mason and Associates is solid. We cannot promise that there will never be a fee increase, but it's not because of what's happened this year. And my guys, please, if there's any other things that you guys would like to chime in there, that'd be great.
No, that was a great answer, John.
And I'll just tag on a little bit to that. And this is why we love the fee only model is when the client's assets are down, everybody's revenue, SCMs, Masons, everybody feels that pain. So we're all in this together.
Great point.
Thanks, Jeff.
So another question is, and I think we might have to interpret this based on how we read it. In today's economic situation as a CSRS retiree, what would be one's percentage investment portfolio? So I'll interpret that as, hey, I'm a CSRS retiree. I've got a big pension coming in. What should my allocation between stocks and bonds be? And I think Tommy, John, Jeff, anyone can kind of jump on that one.
Well, Tommy mentioned in the chat to us, we just released an episode of the podcast, Federal Employee Financial Planning Podcast, episode 22. It's titled 100% Probability of Success. And that's a little tongue in cheek because, again, as federal employees or folks with pensions, as long as you spend less than what your pension is, your plan was always going to be successful. So when you look at your probability of success in Right Capital during our planning meetings, we're showing you the likelihood of inheritance. We're not really showing you, are you going to be able to be retired? And that's kind of a general statement, but generally, if you're a federal employee with great income or Centera with pensions or what have you, Social Security you delayed till 70, you have great guaranteed income. This is really saying, am I going to leave an inheritance? With all that being said, this was a really big change when Tommy and Ben started working at Mason and Associates, because they were surprised to see many of our clients in the moderate conservative or balanced portfolios. And they said, John, how come all of our clients are so conservative? And I said, well, they get to invest how they want to invest, because generally speaking, our client financial plans are successful, whether they're 100% bonds or 100% stock. So it really becomes, where are you comfortable and what's the investment experience that you want to have as a client of Mason and Associates. So if that investment experience is a lot of volatility in your CSRS, you could be 100% stock. Conversely, you could be 100% bond. We're biased, I think, at least Tommy, Ben, and I, to that 60-40 portfolio, as it provides a lot of, or a decent amount of upside with some risk mitigation. Mike and Ken may tend to be a little bit more conservative, and then Jeff's going to have his thoughts too. But if you have all your expenses covered in guaranteed income, you get to design your investment experience. Now, there are people on this call who don't have that luxury. And we have seen investing too conservatively, the plan doesn't work. Investing too aggressively, the plan doesn't work. And for those of you, if there are any on this call, you're invested in a risk profile or risk tolerance or model portfolio designed to achieve the objective of you having enough money to get through your retirement. And if we need to change that objective up or down, that may result in a change in spending or a change in other assumptions. So for those of you without pensions, know that the risk you're taking, the equity portion of your portfolio, is designed to help you get through retirement without running out of money.
I want a great answer, John. We hate saying consult your advisor or the answer depends, but often a lot of these answers are going to be, well, what are your goals? What does your individual financial situation looks like? So if you are someone who's saying, man, do I have the right percentage in stocks or bonds? Please make sure you're giving us a call and make sure we're having that conversation. But maybe similar to that question, and Jeff, John, anyone can answer this question that we have is, if I could revert my money back to TSP to stop the loss on investment until the market does better, would that be ideal? I know that's kind of a loaded question. Obviously, it would be ideal if we could stop the loss, but there's always the problem of getting back in. And Jeff, I know you have some good data around that.
Jeff, let me take the first stab real quick. Number one, that SEM Traders blog was really valuable in those 3 speedometers. We are bearish across the board. So if things get worse, we are positioned about as good as you can be positioned to weather that storm, which I think we take a lot of confidence in that. And we also know that if we're wrong and the market starts to improve, together with SEM, we will redeploy those assets into more risky assets, and you'll see that speedometer start to increase again. Does flocking to TSP make sense, or fleeing to TSP? TSP is wonderful, but we own S&P 500 index funds in the accounts with us. It's the same S&P 500 index fund that you have at TSP. The F is in Frank bond fund is down more at TSP than our core bond fund because it's more of a static allocation versus actively managed. I think the gist of this question is, I'm really scared, and that's okay. Should I move to the G fund? Because the G fund is the only investment that we're aware of, other than like I bonds and CDs, that guarantees you that you're not going to go down. And does flocking to cash, which is essentially the root of that question, do we move to cash right now? The answer would be, we do not think moving to cash is a good idea, because 1, you have to make a good call getting out, and then 2, you have to make another right call to get back in. And at least, Jeff, in our experience, it's really easy to leave. It's really easy to hit sell and move to G, but there's going to be events over the next decade that continue to make you not want to get back in. And what do I mean by that? In 2011, there was the tsunami. Then the US debt was downgraded. Then there was the war. Then there was Brexit. Then there was all of these things that have happened in my 10 or 11 year career that could have prevented somebody from ever leaving G. And although this year stinks, there's going to be things that happen every year that make you never want to leave G fund. That's a scary position. And I don't think fleeing to TSP for volatility protection necessarily makes sense. Finally, on that is, everybody's probably aware on this call, we're compensated by the assets under management. And one of the ways that we get to be your advisor and do all this really fun financial planning and tax planning is because we're being compensated to do so transferring assets away from Mason and Associates into TSP, probably, would put us in a situation where we can no longer have a client and advisor relationship because it wouldn't make economic sense. We have to be all in this together.
Yeah, I think that's a great point. And there's a, I'll just add on for the sake of time. I've done this for 25 years and I followed the markets for 30. And when the best time to invest is when the most people hate stocks. And to this, I'll add bonds because that's the case. And so we've had two cases recently going back, 14 years. But so the first one, and I'll never forget, December 24th, 2008. If you remember, if you were following the markets back then, and I know John and Tommy were still in school, and Ben, but everybody was so negative on everything. And the whole world was going to implode. The Wall Street was going to go broke. We got a buy signal in high yield bonds for tactical bond. And on Christmas Eve, Rick and I always let everybody else have the rest of the day off because it's a half day for the markets. And we'll watch the systems, we'll make our trades, and then we'll go enjoy Christmas. And I woke up, ran the data, and I called Rick and I said, so it's saying to buy high yields. And he's like, well, let me check the data. We can, because sometimes you can get bad data. And he goes, no, I agree. The data says buy. I said, all right, here we go. And, this was back before everybody had, text messaging and free smartphones and all that. We came in to December 26th and our voicemail and email box was full because people had checked their trades online and said, have you guys lost your mind? Do you not have any clue what's going on in the world? No, that was not the ultimate bottom, but tactical bond made 9% on that trade before it sold again in February. The ultimate bottom, of course, came March 9th of 2009. But we were blasted by our trusted clients for buying. We had actually gone to cash the end of June and basically sat there for 6 months. So the other time was during COVID, third week of April. With hindsight, the market had already bottomed, but we got a high yield bond buy signal and we got back in and everybody, our advisors, client, not you guys, of course, because you knew ahead of time. And John and Tommy, and they're like, when could we buy? Because they understood that. But we were blasted because we bought. So, and I've seen it happen. I saw somebody go to cash and never get out, like you guys mentioned in 2008, and they never came back. And it becomes hard. If you look at the fund flow data, most investors did not start getting back into the market till 2015. So 6 years after the market bottom, they said, maybe it's not so bad because like you said, there's time and time again. So our goal is to sit in low risk investments as much as possible. If you are that risk adverse, fill out the risk questionnaire. Let us know who your advisor is. We'll take a look because we have some very low risk options that have the potential to get back in without you having to say you feel good right now.
Thank you both. That is certainly some great and wise information. It's not just getting out, as John said, it's when do I get back in? And Jeff, you mentioned people sold out in 2008 and 2009, and they weren't fully back in until 2015. Think how much they missed. And there's always an emotional reason to want to be safe. Mm-hmm. Let's maybe go. Do we want to try to wrap up by 5:30? We have probably 5 or 6 more questions. Do we want to go lightning round on a couple of these? Yeah, let's do lightning round. That sounds great. So lightning round, John, I'm going to give this one to you. So if your military retirement doesn't exceed $40,000 yearly, will it be tax-free by 2025? The answer is yes. So $10,000 this year, $20,000, $30,000, then $40,000. I think we're still waiting the exact rule from Virginia on where that deduction will occur. Is it a subtraction? Is it a deduction? What's the code? But right now we're incorporating that into our tax plan. And I think you have to be 55 or older, Tommy, for that to be effective. That's correct. Jeff, will these charts be made available?
Yeah, there's nothing in there. We can get you guys a copy. Actually, I sent you guys a copy. So
So
we
yes,
can make that happen.
If you are interested in seeing the charts that Jeff went over today and some of the information, rather than us just sending it out to everyone, please email us and we'll give you a copy of this. We also are recording this, so we can send you a recording of this webinar at all. Another quick one for Jeff: are 1-year Treasury bills a good option for cash currently sitting on the sideline?
Consult your financial advisor, but if say, and I've told people who, they did their $10,000 in I-bonds per person in their household, and they do just want to lock up their money for a year. The 1 year is like at 4.3 or 7. It's a nice rate, but that's only if you want to lock your money up. It's going to be volatile if you're trying to get in and then get out. So it's attractive. We own quite a, John mentioned core bond. We have a bunch of 1-year treasuries in there. So our models agree that it is. But again, if you need to lock your money up, talk to your advisor first. Make sure you have it under control.
Should we be anticipating a recession/market drop? How does the current conditions affect retirement? So it looks like we've got someone who's thinking about retiring within 2 years and they're wondering about a market drop. I'll go ahead and answer this one. If you're retiring in the next 2 years and you're seeing a market drop and you haven't talked to Tommy, John, Ken, Mike, or myself, and we can also include Jeff in that conversation if we need, we need to have that conversation. In most cases, if you're someone who's been saving all of your life, like most of our clients have, and you've got a strong pension income and strong Social Security income coming after that, it may or may not make sense to delay retirement. But I think certainly we need to have that conversation and run through the numbers before we can answer that for you.
Yeah. And I'll just add, our base case, because of our economic model, and then my experience for 25 years is base case is yes, recession, probably start sometime next spring. That we should just plan accordingly. And if we're wrong, great. We got ready for nothing, and then it's off to the races, because the models will jump back in before the recession's over if you base it on our history.
Jeff, this one is specifically for you. And again, maybe we can go quickly on this because I'm sure there could be spent a lot of time, is what tools do you use to prognosticate the market trends to keep the risks below the level advised by your clients?
Yeah, I won't have time to share it now, but we actually have, it's called a toolkit. We have all the Mason models in there, and we look at not only what it's lost historically, but we have a statistical model in there to look at what's the potential risk that maybe hasn't happened yet. Just for reference, we're about, if you look at the median bear market, we're 2/3 of the way through. All of our models are 2/3 or less of the risk that we modeled before the bear market even started. So it's a toolkit that all the advisors at Masons I know use a lot to help you guys set it up. And it's all based on statistics, again, not opinions.
Wonderful. And then maybe the last question, second to last question here. What were to happen if the US dollar would go to a 100% digital currency? Jeff, I'm gonna give that one to you.
So, first off, we're probably I think they said 70% digital anyways. And that if you consider your credit cards, your Apple or debit card, Apple Pay, when we send money to clients, it's literally all digital. It's one computer telling the other computer that it's there. I think some of the things I've seen on social media are kind of hinting that they're trying to do something with the dollar to be more global. We're already digital is the main thing. And the reason the US can borrow so much money is the dollar is still the way most businesses transacted across the globe, which again is digitally. It's one bank telling the other. So the reason Europe and China and Japan and everybody else is struggling more than we are right now is because the dollar has gotten so strong because it's viewed as a safe haven. So I think that's kind of two questions in there, is that the dollar is as long as the US needs to borrow money, no government official is going to want to get rid of the dollar. The second part of that is the reason we're able to borrow so much money is because demographically, growth-wise, we are so much better off than every other developed country in the world. And, well, we have our own issues, but we're way better off than most countries.
That's a great answer, Jeff. I think sometimes we all forget that. I can't tell you the last time I carried a wad of physical dollar bills in my pocket when I was going somewhere. So much of our transactions now are digital. Last question here, and we'll go quickly. This is, I think, a question that we could all participate in, and maybe I'll start off first. It just asks, how's the family? So I have some good updates. Personally, for me, last Sunday, I proposed to my girlfriend, and she said yes. Ken Mason did, in fact, lose $10 on that result, but we are very happy. And I probably haven't had most of you on this call, but I'm thrilled to be here, join the Mason team in January, and it's been a terrific group to work with. Ken, maybe you can give a family update as well.
Family update. Both my wife and I went through COVID. We came out the other side looking good. It was just a couple of weeks of feeling bad. We just got back from the Black Hills, looking at the president's heads and enjoying the beauty of this great nation. It means so much to take the time out with your family and seeing what great country we do have here. It is beautiful across the United States. Go ahead, Tommy.
All right. I want to make sure we get a chance to hear from John and Jeff as well. Families are doing well. We are having fun with a toddler right now. So some days she is adorable and just a blast, and other days, we just have to deal with a toddler's mercurial emotion. But it's fun. We're loving every day is a new milestone. Watching her grow has been amazing. And I will, if I can do this, I will share a quick photo from Halloween, since that was recent. So hopefully you can see. There was Zoe. She was Minnie Mouse for Halloween, and Harper was forced to be Mickey Mouse. But everyone is doing well. Thank you.
Jeff.
Yep.
Yeah. So for those who didn't meet me, we have 6 kids, and we kind of have a long range of things. And our oldest daughter's already given us 2 grandchildren, ages 5 and almost 2. And they live 20 minutes from us. And so we love being grandma and papa. With that, we found out our son in Arizona is having their first child in January, although he's hoping December for the tax break. So a lot more trips to Tucson for us. And then we're enjoying having our last 2 in high school. We have now 16-year-old twins, sophomores at New Kent High School, doing high school sports and having fun with that. And kind of in between, we're almost empty nesters, which we're sad about, but it's a lot more fun to be a grandparent than it is a parent. So we've been where you guys are at, and we're glad to be on this side of it.
Yeah, I just wish that somebody would have told me early on, because it's like, oh, you have a newborn, you're not going to be able to sleep that well. They should have said, you have a child, you're never going to sleep again. That would have been some nice advice, I think, early on from Ken or Jeff or Mike or Bobby or any of my mentors, So, but things are good. Things are good at my house. Sarah and Carter are doing both of them really, really great. Carter will be 3 in November, and he loves hanging out with Bobby and Poppy. So my dad is Poppy. My mom, Bobby Mason, she wanted to be Grammy, but Carter insists on calling her Bobby. And the funny story there is they were out at McDonald's the other day getting some ice cream, and a nice lady came up and said, "Oh, you're a cute little boy. Are you with your grandma?" And he said, "No, this is my Bobby." So things have been really good. Personally, we're looking forward to the holidays. We are pressing through end of year tax planning season, and upcoming trips for us are exciting with the RV, maybe spending a couple of weeks out of the office in the not too distant future, and then a ski trip in February. So a lot of good stuff. I couldn't be happier. And I know all of us feel this way, but our spouses, we couldn't do this without them. And so thank you to all the spouses and fiancés and team members on both sides. We wouldn't be able to do what we do for you, our clients, without the support of all of our family members. And then just wanted to kind of close up with thank you. Many of you have been clients for years or decades. Some of you are brand new, and we just sincerely appreciate the trust and the faith that you've placed in Mason and Associates. And we encourage you to remember, if you have pensions, those are your largest assets. It doesn't mean that what's happening right now in the stock market isn't important, but we're here for you. If we need to have a conversation, we'd love to do that. We don't want to make a change unless something is causing us to do that. Current market environments should not derail your financial plan, should not derail your ability to retire in the next year or two. Does this make it more stressful? Yes. Does retiring when the market's down, is that a stressful occasion? Yes. But that's what we planned for. We were ready for this. You were ready for this. Thank you for being here. Thank you for being clients of Mason. And thank you, Jeff, for participating in this call.
Yeah, thanks for having us. This was a lot of fun.
Good night, everybody.